Welcome back, everyone. Karl Weiss here at Fairway Independent Mortgage Corporation, joined today again by Mr. Clayton Janson, certified financial planner, walking us through some amazing financial literacy concepts. And for those of you joining us now, we recently covered just a fantastic segment on sort of the risk tools and assessments that uh, Clay offered for free to and walked us through, getting us down this road of okay, where should we be, right? Where is our risk tolerance in three different categories and having kind of a blended rate between the psychology of, how we approach investments, our knowledge, our capacity. And that's a fantastic tool. So for the example purposes, we ended up at, like we just call it a 50-50 blend, where we were essentially inputting data in saying, okay, we were going to invest money. $10,000 was our sort of our seed fund into a medium-term bucket, which our goal was 2 to 10 years for time horizon. And the assessment spit out a number that said, hey, about 50% should be in equities and 50% should not be in equities. So basically 50% in equities, 50% in fixed income or bonds. Is that a fair
Yep, that's perfect.
encapsulation?
Yep.
Great. So now let's take that step of the maybe somebody who's joining us who's accomplished all these goals so far, right? They've done a budget, they know where their funds are, they have an emergency fund, they've got 6 to 9 months of liquid funds in a savings account that's not invested in the stock market, and they've got an employer-sponsored plan. They're working towards their retirement goals of, putting 15 to 20% of their funds for retirement, and now they've got some leftover funds and they're like, yeah, but it's not not tomorrow and it's not for retirement. Between now and then, this 2 to 10 year time frame and this bucket that we want to put money into, which would be a non-qualified or just a regular after tax so that we don't hit jargon too heavy with people out there. Let's start putting some money for a future purpose, whether that, 5 years from now we want to purchase a car, or in 10 years we may need a new down payment, or we would like to buy an investment property, or we have some other asset that we'd like to obtain. Um, and we've got this $10,000 and we now know 50% of it should basically be into the equity market. How do we go about that? What's sort of the next step?
Yep. And that is a great next step. And I want to start maybe by saying maybe a short list of what we don't do. And then maybe we can kind of,
Great.
then we can flesh out what we might want to do. We get clients often that have this situation. And every once in a while, we get a client that says, Clay, which one stock? I've got this $5,000 account, $10,000 account. It's all the things, Karl, you just mentioned. It's this midterm bucket. I don't need it for emergencies. Which single stock do I buy? Microsoft or Nvidia, or right? What do I buy? The hot new stock. And that's exactly where we don't want to start, right? We actually don't think you start with putting it all into one stock, right? That could take on so much risk, even though you could say, well, Clay, I'm going to blend that one stock, just like you and Karl was saying, I'm going to do 50% in that one stock and 50% something else. But that one stock has so much risk that you could lose that money so quickly. So we start by saying, let's not talk about a single stock, but maybe explore some options that keep you diversified, right? And that was a concept we probably chatted about a couple videos ago. We want you to be diversified. We don't want, what is that old saying, right? All the eggs in one basket.
Correct.
So I think when you start thinking about it that way, then the question becomes, okay, if it's not just one investment or one stock, what tools are out there that we could use that could help spread that risk to keep us diversified, but to
Mhm.
keep us close to that 50-50 that we're talking about here in this example. And I think one of the easiest tools to talk about right out of the get-go, just a fundamental investment, it's been around for decades, it's the mutual fund, right? And a mutual fund was created for this exact purpose. It was a tool that was built to have a single investment holding that has many investments inside of it. So imagine it. I kind of think about it like going to the grocery store. If you're going to the grocery store and you get your groceries right in your basket and you go to the checkout counter, and they're putting all their groceries, all the groceries you just bought into one bag, right? A paper bag. Let's take that old paper bag image and all the things that you can put in that paper bag. You could put Coca-Cola in there, right? You could put Del Monte green beans in there, right? You could put, right, a Starbucks gift card in there, right? You could put all of these things inside of that one, right, bucket, as Karl and I like to talk about it. But in this case, it's a mutual fund, right? You're going to put it all into that one basket. And mutual funds have been around, like I said, for many, many decades. And it's a great way to stay diversified. And you can often get a lot of these mutual funds for very, very, very low cost, very manageable, because those buckets are being managed by an active management team. And some of those names you probably recognize that you're thinking about in your mind, right? Fidelity, Vanguard, John Hancock, right? Lots of companies out there that are doing investment mutual funds. So I think that's a great place to start. Is maybe, Clay, where can I go with this 5,000 that's diversified? That's a mutual fund, so I'm getting lots of things in one single investment.
I love it. And I think, sometimes people will have this concept of, wanting to invest in stocks, but don't fundamentally understand how many dollars you might need to have individual issues and to have a stock portfolio, even if you just looked at it from a raw cost aspect and said, hey, most traders and trading platforms would like you to buy what they call a round lot, right? Which is 100
Shares.
shares of
Yeah.
any given stock. And when you take a look at some of the cost for 100 shares of Berkshire Hathaway or 100 shares of Coca-Cola, very quickly you can come to the understanding that you may not, with your $5,000 or whatever the seed money is for this bucket, not only may you not have enough for a round lot of any of them, but you may only have a few shares. And that is not going to be sufficient, probably, on that risk assessment because it really didn't take into account that you were going to throw all those eggs into one basket, right? And so I love the idea of mutual funds and really how they say it 100 years ago, like the chances of all, let's say a given mutual fund is a basket of 50 or 60 different stocks, the chances of them all going to zero is pretty remote.
That's right. Exactly. Yep.
And
And
so
there's a
now in this example, we have the opportunity to invest the money into you know, a professionally managed, situation where a manager and a management team is picking and choosing the individual issues underneath uh, of the umbrella of whatever it is that we're investing in, and we get to actually choose. There's a lot of choices of types of mutual funds, right? Like maybe you could talk about some of that.
Yep, there are. And I'll briefly mention, and you just hit it right on the head, is that the mutual funds that we're talking about, there's lots of different flavors out there. The ones we're talking about for this portion of the video is professionally actively managed, right? That's what we're looking for in this particular case. But I want to say there's a lot of other mutual funds, and then there's some cousins of mutual funds that we also like called exchange traded funds. Um, but in those cases, maybe those are better suited for folks that might have a little bit more knowledge or a little bit more experience with investing. And then you're designing maybe your own portfolio of non-actively managed designs, right? So maybe that might be a
Right.
good thing to cover in the future. So what Karl and I are talking about here is really kind of that initial step into saying, Clay, I've got these things checked off my list. My next step is this medium bucket. I'm looking for some actively managed mutual funds to keep me diversified for all the reasons that Karl and I were just chatting about. So yeah, once we get inside the mutual fund, Karl, I kind of think about it in terms of 5 different variables that we can track, that we can, as if I'm a new investor, it would be easy to pick a few data points that we could kind of sink our teeth into to help us understand, are we on the right path for a mutual fund? Maybe we heard an advertisement, maybe we're talking to a friend or a neighbor or somebody at work. What are the ways that we can look at a mutual fund and really understand, is this thing going to fit my design, right? And fit it from a risk tolerance that we had talked about on our prior video, fit it for, hey, what am I trying to accomplish, right? Just with the goal of this fund or how much risk it has. So I'm going to go through
Love
those
it.
5 things, yeah, that I
Please.
would share with anybody. And again, this isn't if you're managing your own funds and you've got decades of knowledge. This is just a good spot to start and to kind of get some wits about where do you go next. So
Great.
if you're looking at a mutual fund, I think the first thing that you want to look at is what I like to call the style or the category. So
Okay.
is this mutual fund buying US stocks? Is this mutual fund buying international stocks? What is its purpose? A
Mhm.
lot of times that's defined legally in our world in what's called a prospectus. A prospectus, that's a really fancy word for saying, what did this mutual fund tell the federal government that they're buying or purchasing, right? Because this is a security and you're going to be purchasing something on the stock market. So it does have to disclose, is it a large US stock fund? Is it a small international fund? What is its purpose? What is it buying? So finding that first, I think, is really important so you know what you're getting into. Second thing, I want you to verify with the holdings. You want to find out on the holdings inside of that mutual fund. Karl had just mentioned a lot of these mutual funds are going to hold 40, 50, 60 or more stocks. You don't need to look at all 60 stocks in that. You just really want to kind of look at that top 10, 15, 20 stocks maybe, and just get your eyes on some of those names. If the style says it's a large US stock mutual fund, guess what names you should probably see
Mhm.
in the holdings? You should
Ones
probably
you can
see,
recognize.
that's right, ones that are in your pocket,
Yep.
in your grocery store, in your car, right? Like you're going to see Amazon, you're going to see Apple, Microsoft, you might see Johnson and Johnson, Procter and Gamble, right? These are the names that are just going to jump at you and go, "Okay, I'm trusting that it's a large US stock fund, but I'm also verifying." Karl, I'll tell you, I've analyzed a lot of people's mutual funds. It happens more often than you think. You'll look at an international mutual fund and it's holding Apple stock. If if
Wow.
there's a if there's a mismatch there, something's wrong. Something's afoot, right? They're trying to game the system or they're trying to put goose their returns.
Mhm.
And although that sounds like what they're trying to do is going to benefit you, it's also could backfire, right? So you don't want to invest in an international fund if you're not actually getting international stocks, right? Because
Correct. Yeah,
you're
because your whole assumption is going to be wrong.
that's right. You're going to go into it going, oh, hey, I felt good about stepping into international, but now I get the US stock market exposure. So we want those two things to match. So
Correct.
first one is style, second one is holdings. The third thing to look at is how long has this manager or this team been working together,
Hmm.
right? Is it 3 years? Is it 30 years? I like to target 5 years or more. And an analogy I share with clients pretty often is it's just like if I was going to go in for a heart procedure, right? If I'm going to go in for some sort of heart surgery, I would like to interview a number of heart surgeons that have done this procedure 14, 18, 32 times, 60 times, right? I want to make sure that they've been doing this a while because if I go under the knife, I'm not saying that new doctors don't need to learn. I'm just suggesting that if I'm going to give somebody a recommendation or if I'm an investor, I don't want to try out the new investment team. I want to see a
Right.
team that's been through a recession or two. How did it work? Were they able to get some risk reduced? Were they able to take advantage of the rebound? I want to see their experience through the thick and the thin of the economy. So 5 years pretty often does the trick. Usually when we're working with clients, we're looking at teams that have been doing this 10 years or more, just to give that a little bit more depth. But 5 years is a good starting spot. So
Okay.
what's the style? What are the holdings? How long is this tenure of the team? The fourth one is costs. And sometimes that shocks people when I tell them costs is fourth on the list. But that's important because I just want to make it clear costs are important. We want them to be low for sure. But I think there's a couple of rules at play here. I think most of our clients and most of your listeners, Karl, on your podcast know there's no free lunch. And
Right.
so because there's no free lunch, there's no free way to get this mutual fund. So free doesn't always mean better, right? There is no free, and if somebody claims that it's free, you need to run the other way. If you're seeing marketing or advertising that it's free, something's definitely up.
Agreed.
But I also don't want to say that expensive is better, right? There is a happy medium. We often say in the actively managed mutual fund space, if you're less than 1% on fees, that's a good place to start. But if we can keep it even lower than that, somewhere between, 25 and 50, what we call basis points, or 0.25 to 0.50 per year. So less than 1% is ideal. And if you're comparing mutual funds, you're going to start to see where the average is for the group. So if you can kind of be below the average of the group that you're looking at, that's usually a great place to start. All right, so we've got the four. The fifth one, I think, is probably the key piece to the puzzle. The fifth one is what we call peer group performance.
Okay.
Peer group performance. So what does that mean? If you're in high school, and let's say you're a sophomore in high school, and you're comparing your grades and your performance to all the other sophomores in your school, that's what we call peer group comparison. We're comparing all of these large US stock mutual funds, right? We're not trying to compare apples to oranges. We're not trying to compare international stocks to US stock money market, mutual fund managers. We're trying to just compare apple to apple. So wouldn't it be nice if we could take a look at all the mutual funds that we're reviewing and see how they stacked up with each other, right? So we're going to compare maybe 3 or 4 or 5 mutual fund managers and say, okay, how did they compare in their peer group? And I'm not just talking about 1 year, Karl. I'm talking about 1 year, 3 years, 5 years, 10 years, right? We need to see how they stacked up, because just like high school, you might have had a good semester, but did you have a good
Mm,
4 years in high school? Did you have a good
right.
4 years in college? Yeah. We want to know over the long term. Remember what we said about manager tenure? We want 5 years or longer. How did they stack up over those 5 years versus everybody else in that same style or category? Not just, hey, was it the most return last year? This is what was the performance of all of them and how did they stack up? And I will tell you, a lot of folks don't take the chance when they're making investments to look at it that way through this peer group lens. But once you see where your mutual fund stacks up, or the 2 or 3 that you're looking at as candidates, it just jumps at you off the screen, because you can then see immediately, oh my gosh, they're in the top 10%. And if they're in the top 10% every year over those 5 years, you've got a pretty good team on your hands. So I think that's a great place to start. If you can look for those 5 things and verify those 5 things, all of those data points should be easy to find online. You can Google a lot of this information. Even some resources that you can tap into, shouldn't be any cost. Morningstar is a great option to use. You can actually go on there. They have some basic public information, and a lot of the data points I just shared with you are free and publicly available, if you want to start looking at some mutual funds.
Well, great. I was just going to ask, like, what are some of the analytical tools that we could have people look at that are, accessible and free and don't require subscriptions and crazy logins
Yep.
and all of that. So, maybe I'll have you circle around on the Morningstar front, to give us kind of a glimpse of what that looks like, and so maybe, people can take a look at that with us, uh, to be able to analyze a given fund. And it kind of brings me back too, because one of the thoughts was in our example where we had $10,000, and I can't wait to see, if the end result was essentially put half of it into equities, right? Um, I can't wait to see how we break that up. And when you mentioned the things that we're looking at, that I can't wait to see how these dovetail between, the style, the verifying they're actually doing what they said that they're going to do, the management team that's in place, costs, and the comparison to the peers. But the one question I had, I guess, real quick, just to circle back on the fees, as we all know that fees are important in, all of this stuff. How are those actually accounted for if we say, we put $10,000 into, a brokerage account to open this thing up, and we're getting ready now to actually invest money for the first time, and we find that, okay, we've got this mutual fund and it has fees. How do we pay for these fees?
Yep. So the fees are going to come. That's a great question, because we get that a lot. And when we say in terms of percentages, sometimes I think people get lost, and it's totally natural in just what does that mean in dollars, right? And then it's converting that to dollars, and then also the how, which is I think the question you were also asking right there.
Mhm.
So in your example of the $10,000, right? If 1% was the fee on this account, that's $100, right? So 1% on the 10,000 is $100. So that $100 is going to come out of your balance. And I know this sounds strange, but it comes out on the back. You're not going to write a check. You're not going to swipe a debit card. You're not going to lick a stamp and mail the right mail a check or a money order in. The fund manager is going to take it out of your account, right, automatically. So I kind of call it out the back door, right? So
Okay.
it's going to come out directly. And it often is a reflection of the performance itself. So a lot of times you'll say, hey, the
Hmm.
gross gains that I made on this fund might be 10%. But if the fund manager took a percent out, you would only make as the investor 9%, right? So that's
Great.
another way, yeah, another way to think about it. Now, that also can get dangerous because sometimes people say, but Clay, what if the market is down? Well, if the market was down 10, that fund is going to still take out that 1%, right? So you're going to be down 11, right? You're going to be down 11% net.
Hmm.
But anything less than that 1% number, so if we can keep it below on our $10,000 example, if we can keep it below $100 per year, I would think that would be a really good place to start and definitely a success.
Absolutely. Okay, great. Thank you. I just want to make sure that people understand how the fees piece of this works together. In addition, to the professional management, which is obviously critical here. It's one thing to want to invest money and make a return and uh, assume a little bit more risk. It's another thing to have to do everything from scratch while maybe learning at the same time, right?
Yep.
Um, so can you share with us some of the analytics of like how to, all the stocks that are available, all the mutual funds that are available, like where do you start? How do you
Yep.
start? And
Yep.
how do you do any of the comparison work?
Yep. I've got an example of a morning star. You want me to pull that up for us?
I would love that. Yeah, that'd be
Yeah.
great.
Yeah. All right. Let me go find that example here. All right. Let me know when you see that up on the screen, Karl.
Got it.
All right. So as I mentioned, one of the analytics tools that's out there that you can use is a company called Morningstar. They've been around for many, many years. They're probably the gold standard when it comes to analytics of mutual funds. But feel free to just Google that and look for Morningstar, and you can put in much like you would with a Yahoo Finance or Google Finance type of search box. You can start to look for mutual funds that have some of these characteristics. So we just happen to be looking at the Fidelity Advisor Balanced Fund. And I
Okay.
should start by saying that Fidelity is not paying us anything to mention this. This just happens to be, yeah, a fund that we come across pretty often. But feel free to use it in your search box as just so you can verify the information that we have here and kind of get comfortable with it. But really, those five things that I was talking about up here on this top right corner, we're going to see the category, right? This happens to be a moderate allocation fund. All right, well, what does that mean? This is the category or style. So that means that there's other funds that are also saying out there that they're the same category. That way it makes it easy to compare. So let's drop down into the analytics a little bit. And there's a lot going on here, Karl, but I'm going to stay focused on those five areas for our viewers. And we can always double back on and talk about some other stuff. But if I go right here into the center, you can see that it's 59% in US stocks and about 4% in non-US stocks, right? So when I add these two numbers up together, we're pushing pretty close to that 63, right? 64% mark in stocks all in. But that means there's 36% or so somewhere else. Well, this fund actually balances, that's why it's in the name, it balances stocks and bonds together in one. So this might be an
Hmm.
interesting tool for somebody that is looking for something that diversifies stocks and bonds together. Well, how do we know? I mentioned earlier, we want to trust but verify, right? We want to see it to believe it. So we can come over here to the far right side and we can see some of these top 20 holdings. And lo and behold, there's some names we should recognize, Karl, right out of the bat,
Hmm.
right?
Right.
Microsoft, yep, Apple, Amazon. But also notice we're going to have things in there like treasury notes, right? On the bond side. So this is verifying that it is doing exactly what it says it's supposed to be doing. It's a moderate allocation of bonds and stocks, and we can look and see what are they reporting as their top holdings, right? And how much are in each of those top holdings. You can actually see on the far right side. All right, so this is definitely verifying for me those top two things. It's doing what it says it's supposed to be doing from a style and a holdings perspective. The third thing that I mentioned was the manager tenure, right? So we're going to scroll down here, and right here at the bottom left corner, we're going to see that they've been doing this for 16.1 years. Well,
Wow.
my minimum was 5 years. So if this team has been doing this for 16 years, again, going back to the analogy of the cardiologist I was talking about, if you have a cardiologist that's been doing right heart procedures for 16 years, you could feel pretty confident, right? Not that you know necessarily all of the outcomes of those surgeries, but that one piece is important. They didn't just start yesterday, right? This isn't a brand new management team
Correct.
that Fidelity put together. And then coming up here to the top, we can see that the cost, or I should say the middle part of the chart, the cost is 0.54 per year. So as Karl and I were just chatting about, right, the cost is important. But notice that I didn't start with it. It is important. I always want to make sure we tell clients what are the expenses and that we're tracking them very, very closely. But this is less than 1%. So 1% would have said 1.00. This says 0.54. So that's a good sign. I also wanted to make a quick stop here, Karl, and this is a good place to also mention. We're looking at this mutual fund, and it doesn't have a load, meaning it doesn't have a commission to get into it up front, right? So when you are looking for a mutual fund and you're going to do this on your own, I would definitely recommend looking for a no load mutual fund as maybe one of your first picks. There
Okay.
are some really great mutual funds out there that have a commission to get in. I don't want to say that there aren't some good options out there, but maybe if you're just getting started, it might be a really great opportunity to start with no load or no commission mutual funds. That way you don't pay anything to get in. You're just going to be paying this annual fund expense, right? So look for maybe some no load funds to get yourself started.
Can
And
I
then
jump in
last,
here real quick? Because
oh,
I have a
please.
couple
Yep.
questions as things I just thought of as we're kind of analyzing not only the Morningstar report, but the thought process behind this, right? From going back to that risk assessment where we were essentially 50% in stocks, 50% in bonds. Initially I thought, okay, and maybe a lot of people out there have this thought process, and there's a million ways to do this, but in my head, I was thinking, okay, we've put $10,000, let's say we've started a brokerage account, right? This is after-tax money. This is just money in an account in our name that we're ready to start investing in the stock market, and perhaps, we could allocate $5,000 towards, stocks and, approximately 5,000 towards bonds, but as we look at the mutual fund world, it occurs to me that, while we could still do that, we could also put all $10,000, let's say, into a mutual fund like this that's already broken into those approximate percentages that meets, the style of what we're looking for, that's actually investing in what they said with the management team in there with the costs, that are very reasonable, right?
Absolutely. And that is absolutely correct. And my other favorite part to that, just to add a little bit of subtlety to it, is as the market changes, as the economy changes, as some of these stocks and bonds go through their own cycles, right, on their own, the management team, in this case, Fidelity at the Balanced Fund, who's been doing this 16 years, they can make those small adjustments internally in between different stocks, different areas, bonds and stocks. So you'll see them actually make even subtle changes on your behalf because you're saying, hey, I'm comfortable in this zone, this approximate zone of risk. And you're paying them that 0.54 to make those adjustments. So you don't have to worry about making some of those externally on your own. So, yeah, for all those reasons.
Because otherwise, we would be thinking at some point, right? And I'm sure we'll discuss the rebalancing of a portfolio at some point as far as the percentages and the allocations of each thing. But honestly, that becomes kind of mind-numbing to a lot of people.
Yep,
And not that, we want to have an attitude of, set it and forget it. We're not in this case. This is a professionally managed mutual fund that's sort of done the heavy lifting, essentially for us. And it happens to really coincide that we're going to have these numbers as it's broken down in this particular fund where we've got the US stocks at, just pushing right at that 60% level and, 37% in bonds. And that's miraculously close to our risk assessment in this case.
that's right. Yep.
And
And
so, we can do that by having we're essentially paying them to manage it and they keep tabs of the ratios and the accounting.
that's right. That's right. And this is for, again, to just remind our viewers, this is for that first step investor, that person that's saying, hey, I don't even know where to start. What's a good place for me to start looking and learning and using these, right, these tools or these data points, even if it's just these five things, where can I start looking and learning and
Mhm.
stepping in versus taking no action, right? But you'll get experience to the point, Karl, where yeah, rebalancing is going to come in, or hey, Clay, I've evolved enough knowledge or comfort, right? Risk comfort. Maybe I'm ready for the next step. So yeah, this is a
Right.
great place to start. Fully diversified, professionally managed, but we're taking an active, right? We're reviewing to make sure that these teams are doing what they say they're supposed to be doing, right? We don't want to just blindly put our money into something that maybe we saw on a commercial or online.
Correct. Yeah, and I didn't mean to interrupt you because I know that we're probably not down to the last to the
Oh,
last
we
year.
Yeah, this is
Sorry
good.
about that.
No, this is perfect. These are good questions. So the last piece you heard me mention is peer group performance, and this is really where I think all of those things come together. So this peer group performance is right here in Morningstar's world. They call it percent rank in the category. So again, if the category is moderate allocation, which we're seeing in the top right corner of this form, we can see down here, then how do they rank against their peers? Well, I'm happy to report that this Fidelity Fund over the last 10 years in this 10-year column is in the top 4% of all of its peers over every one of those years, the last 10 years. So imagine going all through high school, 4 years, 4 years of your college undergraduate degree, and 2 more years of a graduate program being in the top 4% of your entire class the whole time.
That's
That's
astounding.
pretty impressive. And I'll point out over that 10 years, their competition went from 490 other competitors to 732 competitors. So it's not like college where you're kind of in a class. This is an ever expanding, right, category group of competitors through time. That's a pretty amazing feat. Is more competitors are coming into the space and they're still maintaining this 4% peer group, which is just amazing. So do any one of these things predict future return? Absolutely not. There's no way to predict future results. But if you use some of these things and start to say, hey, if they stay consistent and I keep my eyes on some of these data points, right, that's a good place to start if you're narrowing down, right, what some of your investment choices are. The average return, notice how we haven't even talked about that yet. The average return for the last 10 years in this fund is 9.79% per year over the last 10 years. I would make the argument that if you're in 40% almost in bonds in this fund and you're still making just about 10% return per year the last 10 years, that's absolutely respectable. So great way to use these data points. Now, again, not saying that Fidelity Advisor Balanced Fund is the only one that's out there that's like this, but definitely check some of these data points out. If you're online, if you're on Morningstar or using another analytical tool, these data points can be really handy just to kind of start narrowing down, right, what some of your choices could look like.
Fantastic. Would you mind scrolling down just a little bit? I wanted to
Yeah.
show somebody who might be paying attention right there, and as far as the holdings go. And I think, this is one of those places that personally, when I think about this concept of, I've got this money, I want to invest it, right? Um, if we had $10,000 and we're paper trading and we had this money that we could actually paper trade or really actually trade, here's what you wouldn't be able to actually buy, right? The list of these holdings, you would not be able to acquire enough Microsoft, Nvidia, Apple, Amazon, uh, Google. Those are the top, Exxon, Eli Lilly, JP Morgan Chase. You wouldn't be able to accumulate enough individual issues of those stocks in $10,000 to really do much of anything, let alone all of what I see down there, all the treasury notes that are at 4% and all of these things. It just wouldn't be, there's just not enough money to adequately do that and diversify of your own money at this
That's
point.
right. If you look at this small type right here, let me zoom in just a little bit, make it easier on your eyes here, Karl, because this is the point that you're making, which is great. 290 stocks, 3,435 bonds. That's 3,725 holdings in this one account that your 10,000, your 5,000 your $1,000 can buy. You're getting a slice out of 3,725 holdings. That's diversification at its finest. That's really the strength of mutual funds and exchange traded funds. But you're absolutely right. You'd be in the multi tens of millions, very likely, even if you bought just one share, right,
Of
of each one
each.
of these things.
Yeah. Yeah. One share each of 3,700 things. Yeah.
Yep.
That'd be pretty impressive. The other thing that kind of jumps to mind is, number one, can you use these kind of tools based on the risk allocation that we've come up with, and can you kind of tweak it a little bit to figure out, okay, well, if my risk uh, analytics were a little bit, let's say, above the 50% or below the 50%, would you change funds? Like would you find a balanced mutual fund similar to this one that maybe was, more 50-50? Or would you say, well, I'll put 9,000 out of the 10,000 in this fund and 1,000 I would leave in a money market to sort of self-balance out if you said, hey, this might be the right fund.
I think both of those are great solutions. I think the secret to the answer is going to be, can you find, so for example, this is a moderate allocation. Can you find a conservative, what we would call a conservative plus allocation fund
Mhm.
that has exactly the peer rank, superior peer rank, good manager tenure, right? Are they doing the holdings that they're supposed to be doing at a fair cost, right? If you can find one that's closer to 50-50, then yeah, I think that's great. But if you can't, I love your idea, Karl, and I think that's a great alternative. You would buy the moderate fund that has all the superior data points, and then you would blend in just a little bit of that money market fund, right? A little bit of that maybe high yield savings, and keep that on the side as, in your example, 1,000 there and 9,000 into this fund to
Just
get
to
the blend.
smooth, just to
That's right.
smooth over kind of that ratio of
Yeah,
stocks to bonds, let's say.
that's right. That would be perfect way to do it. Either one works great. Find a
Okay,
fund that has closer to your target that's superior in those areas, or take a slightly more aggressive version of it and just blend in a little bit more cash on the side in that account. And I think you'll end up with some great results.
what are some tools that you can give to people so they don't have to go search through the 733 US fund moderate mutual funds in this particular group, right? Because that's the category. This one's ranked against 733 of its peers. How do you come up with the top 25%, the top 10%? How do you figure which ones those are without using thousands of hours?
Yeah, I actually, with Morningstar, I believe if you go right to their public website, no cost, right? You should be able to look at that one data point, percent rank in category right here up on the screen on the left, bottom left side. And you can literally start looking right there first. If you want to work backwards in those data
Mm.
points, that might be a good first place to start. Is that way you just start narrowing it down? And so keep in mind, it's the percent closer to the top that we want. Number one is the best, just like it is in
Okay,
in school, right? And then 100 is the worst. Don't think 100 is good. We want to think, right? We want to think, yeah, percent
perfect.
to the top. We want to be in that top 25%. So I think if you
Great.
start there over a 3 and a 5 year period, you will narrow it down so fast because there's just not that many that are going to be in the top 25%, right? But once you find one, I would say start with that 5 year number just to kind of zero in. And once you find a handful that are in the top 25% over a 5 year period, you're probably 80% of the way there.
Perfect. Well, great. Well, thank you very much. And that's some great tools for everybody to take advantage of. And we'd love to hear from you, some of the ones that maybe you've looked up out there. So feel free to drop some of those in the comment section. We'd love to see what people are coming up with out there and finding. Stay tuned. We will follow up in just a few more minutes with another segment.